Thanks for being here. Good morning, Raj. What we're presenting on today is transfer pricing controversy in Ireland. I'm talking about how to avoid such transfer pricing disputes and various dispute resolution mechanisms. So for those of you who don't know us, we're Regan Van Roy. We're an international tax and transfer pricing firm. And, our specific niche is transfer pricing across all the OECD countries. We have offices in Ireland, of course, in South Africa, Mauritius, and Portugal. So I'm Cabrini. I'm the transfer pricing partner at Regan Van Roy. I started out my career with Deloitte in London and worked with Deloitte for many years, and then joined Regan Van Roy a couple of years ago. And my colleague Rajneesh is here. Raj has many years of transfer pricing experience. He was a director at EY in Dublin and joined Regan Van Roy also a couple of years ago to help spearhead our Irish offering.
Good morning, everybody. Glad to be here.
Morning. Okay, so just in terms of what we're planning to cover today, okay, we're going to be talking about some of the key global and Irish controversy trends. We're going to be looking at the Irish dispute resolution mechanisms and principally how to avoid assessments. That's the golden one. Raj will talk us through MAPs and APAs, which are dispute resolution mechanisms for transfer pricing and some of the pros and cons of that. And then we'll also touch on the recent Irish TP controversy. So, it's quite important in terms of what's happening on a controversy perspective lately. But let's just set the scene. So transfer pricing disputes are on the rise. This is a global phenomenon, but we're also seeing it in Ireland, of course, kind of a jurisdiction where we thought we wouldn't have to deal with too much transfer pricing controversy. So the tax law is changing in line with the base erosion and profit shifting project, the OECD, and of course, all these pillars, which require a whole different webinar. And now it's time for businesses to catch up with these changing laws. So what have we seen in Ireland in terms of TP interventions? The 24 stats aren't out yet by the Irish Revenue, but we've seen 33 interventions, which resulted in 748 million euros of tax adjustment, and 233 million of that is interest and penalties. So the important thing about transfer pricing disputes is that they might be select at the minute. The Revenue Authority is just starting to focus on key targets, but the values at play are significant. They're high value disputes. The other thing the Irish Revenue is up to, of course, is the exchange of information through the country by country reports, where the last statistic out there is that there's at least 62 jurisdictions that the Irish Revenue is dealing with on the country by country. So that's significant information sharing and information that's available to various different tax authorities when it comes specifically to transfer pricing. So just a reminder of the recent kind of changes in the compliance landscape. So transfer pricing documentation, as we all kind of know at this point, should be in place by the time of the corporate tax filing. And if we don't do it, we're non-compliant. We have problems with our auditors. We have problems, around the place. But we also have the risk of tax penalties and adjustments and, getting into these disputes simply by not being compliant, even if our model is what we think perfection. If we don't have our basic documentation in place, we're kind of red flagged for a potential transfer pricing audit. So what do we have in terms of documentation? A local file is mandatory for an Irish entity with global group turnover exceeding 50 million euros. So if we fall within that category, there's no joke. Have your local file ready. There's wider master file and other country by country requirements, but your local file is what's really critical to defend your position. And if we don't meet that threshold, reasonable TP documentation is required even if the formal local file is not mandatory. Remember that this documentation is the best and in some cases the only defence against a dispute. So in terms of the Irish TP landscape, it's getting more interesting, right? It started with the Apple case and what happened there, and now we've got new legislative precedent which just occurred. Raj is going to talk us through that case law. But what we're seeing is that the revenue is increasing its audit framework, right? It is starting to actually look at, well, now we've told them they need to be compliant. How do we enforce that, and what's required from an Irish revenue perspective to make sure that the companies are actually keeping compliant? So now just to get into some of the specific global and Irish controversy trends. So like we've touched on, the first trend, and you'll see it popping up on your news feed every now and then, is that TP disputes in general have just increased. 5 years ago, we had a few, and now we have a lot. So it's as a result of the increased scrutiny by the tax authorities. These disputes, some of which are settled, some of which go nowhere, but are leading to an increased trend in litigating. And what does that mean? It means that we're getting increased legal precedents around all sorts of things on transfer pricing that prior to having legal precedent was still driven by your TP advisor for the most part. You know, what can be discussed or settled. There was many grey areas. So this legal precedent globally is really, really important and is helping the taxpayer understand risks and challenges and how to ensure that their own models are robust. Of course, all of this is coming as a result of the increased requirement for compliance. So compliance has been around for a while, but your transfer pricing documentation has just become more important. It's not something to sit on the shelf, right? You have to have it. You got to show you've implemented it. And there's lots of information floating around through these requirements of tax transparency. So we have tax authorities sharing information, and we have loads of new data that's being provided to the tax authority. Your local file, your master file, your financial data, and this information being much more readily available to other tax authorities. So when you have a lot of information in place, of course, there's going to be more scrutiny on what we're doing, and the quality of that information becomes more and more important. What's driving all of this, of course, is the base erosion and profit shifting project, Pillar 2, and the case law that's happening, right? And they're really reshaping TP policies and TP models and making us kind of bring our businesses and bring our models align with the best practice and latest legislation. One of the issues that we have and that we're seeing in the Irish market is this issue of having an outdated TP model, right? So following rules from 5 or 20 years ago, which were quite aggressive when it came to transfer pricing, having to be relooked at, because whether they're not aligned with the new rules around kind of substance and significant people functions, and that tax and profit must follow value creation. All of these principles means that we might be sitting on an outdated transfer pricing model that needs to be updated and needs to be aligned, and certainly in light of the current environment needs to be sense checked. We often get this question, why should Irish businesses care about what's happening globally in transfer pricing? Because typically Ireland is earning plenty profit, right? The Irish businesses there, they're not worried that there's a transfer pricing risk specifically to Ireland. But I mean, what's key is that this compliance, it has to be enforced, right? So as a country, we have to be seen to be enforcing the rules that apply with European best standards, our European counterparts, and making sure that it's robustly implemented. And even if we are not concerned that we're underpaying tax, that we're not eroding the Irish tax base, transfer pricing has more than one side. It can never be looked at solely from an Irish perspective. It's from the counterparty perspective as well. And if there's a risk in the overall model, one side of the equation or not, you've got a transfer pricing issue. And, you know, it will always come back to haunt us, whether we have to try and defend our position or try to support perhaps one of our subsidiaries in defending their position. So lots happening globally. We see the same type of trends replicating in Ireland as we see globally. And case law has a lot to tell us about what to be looking at and where our risk factors might lie. So now to go into some of the specific key risk areas. So what are the tax authorities looking at? Why should we be worried and where should we be worried about? The most simple one in transfer pricing is always loss-making entities. Of course, you have to be engaged in cross-border transactions, and the higher value the cross-border transactions are, the more important it is. But assuming that's the case, if you've got reoccurring losses or you're doing business and performing losses, that's the easiest target for a tax authority. They're going through, looking at who to audit, and they'll often look at that because it's the simplest one to target. Why aren't we making enough money here? Specific to the Irish market is IP transactions, right? We've got a lot of IP and tech companies and all sorts of things happening in Ireland. It's very critical for the Irish economy. The important aspects around IP when it comes to transfer pricing is that legal ownership is not what's important, or not just what's important. Economic ownership of IP is what's critical and being challenged. No more just have a legal ownership. You have to be able to prove the DEMFI functions. So who's developing the IP, who's enhancing the IP, maintaining it, protecting it, and so forth. It's highly interlinked to the significant people function. Do we manage and control the functions around IP? So the big challenge we've seen in Ireland and other countries is, do we have a different economic ownership as legal ownership as our IP? Why does that matter? Because where does the money come that we earn from the exploitation of this IP? And where do the profits relate to that sit? So this is being challenged, and there's a lot of guidance around what we need to have in place for IP, key in the Irish market because IP is critical here. Financial transactions, also, we've seen an increase in the rules. In Ireland, what we will commonly see is a lot of interest-free loans or back-to-back loans, kind of interesting structures around financial transactions with significant financial transactions blowing through Ireland. And often we simply won't have the right support to substantiate what we need for financial transactions, which is two key things. We don't just have to support an arm's length interest, but we also have to support the arm's length quantum of the loan. Is there a commercial rationale for that loan? Would a third party provide that loan? So we're looking at two items there, and they're frequently being challenged by the Irish revenue. Another critical issue is substance and significant people function. So this is linked to the IP, but it's also linked to anything else, right? Do we have the appropriate substance to do what we say we would do? And is that linked to the right people? So, of course, these are generally challenged in low tax jurisdictions. Now, Ireland may or may not fall into the category of that, but it's certainly falling into the category of lower tax jurisdictions. So all the tax authorities know that there's a potential motivation to shift profits into lower tax jurisdictions. So when there's an Ireland popping up in a transfer pricing report, people are more interested in it, right, than another country which has a higher tax rate. And what's key there is to ensure that we've the appropriate substance and significant people function to support the profit that is allocated to that jurisdiction. So whenever we have Ireland in the model, whether it's challenged from the other side, the other jurisdiction, or locally, we need to make sure that our analysis is robust around that, because it's very commonly being challenged that we just don't have the proper amount of people there, or the right people who can manage and control decisions for what we might say we have, or which would align to where the profit is falling. Another item which is similar to losses that is very easy for the tax authorities to look at is when we have significant profit fluctuations. They start to see what's happening here. Did we change our transfer pricing model? Why have we gone from this profit to this level? Is there something happening that the tax authority would be interested in? They're always interested if we're all of a sudden paying less tax, right? So we have to ensure that we have the narrative in our transfer pricing documentation that supports our profit position. Procurement hubs also linked to substance and value-adding activities are also an easy target. Where are we centralizing these procurement hubs? And have we demonstrated the value that has been created by any such hubs, which would substantiate the remuneration that's in our transfer pricing model? They're generally attacked because they were perceived historically to be set up as a way to artificially shift profits. And whether or not this procurement hub was doing something of true value or not was key. And also they've been challenged because finding economic support for third parties doing similar functions as related parties is also quite hard to find in the market, because typically procurement is centralized within a group. So it's difficult to support. So we do need to ensure, again, that there's substance around any of these type of hubs that we create, and that the remuneration model is in line with that substance and value generated. Back-to-back transactions, so kind of indirect transactions. Sometimes people think they're avoiding transfer pricing by entering into some back-to-back transactions or having some indirect transactions which might not be so obvious to the taxman. These are becoming more easy to identify, obviously, through what you're supposed to put in your local file and the type of information that's currently being scrutinized for transfer pricing purposes, and also by the fact that the tax authorities are becoming much more astute to these types of transaction flows that might be in place and are looking for the commercial rationale, right? You have to have commercial rationale to support and justify the nature of your flows. Now, the taxman will always go where the money is, right? So the obvious one that they're going to focus on is high value transactions. So often that's a good related. If you're an import export transaction, that's an easy high value transaction. If you're selling with related parties and it's involved in goods, or you're dealing in IP and loans, they're typically the higher value transaction than services. But if you've got high value transactions, obviously the more important your transfer pricing analysis is, and the more interested the taxpayer is in it, the tax authority is in it. They're not going to be focusing straight away on someone who's paying, 50,000 euros a year in a management charge. They're going to be more interested in higher value transactions because there's more money at play and more potential piece of the pie to eat and to look at. The other obvious one is when your core business is related party. So that means significant amount of the revenue or the expenses is made up of related party revenue. That's because everything that's in your financials is ultimately driven by transfer pricing, right? If we buy everything or sell everything to our connected party, or we're a service provider for group, everything that we do is up for challenge, right? So we need to ensure that we have robust documentation in those cases. They're the real easy places for tax authorities to look. And obviously the information is already available to them in the financials and the tax returns. They don't have to dig too hard to find who to be looking at. Services have always been for, let's say, more inexperienced transfer pricing revenue authorities. They always target services because they're the easiest one. It's much less complicated than intellectual property and other transactions. So they're an easy target. What's important about service transactions is, we're not just looking at what's the markup we applied to it. The big number is normally the cost base itself, and can we show that it's non-duplication of cost? Can we show that there's a benefit? Can we show that the cost base in itself is the right number? And also that it's been allocated fairly among the recipients. Another big one that we have found the Irish Tax Authority flagging is in the case of a recent restructure or acquisition, right? Something new has happened, right? And have we rectified or amended our transfer pricing model to reflect this change in business? So if there's something big happening, the tax authority will flag this as a kind of a common risk, because often transfer pricing might be the last thing you think of, but it might actually be something that they're interested in. So that's a kind of an important one to think about as well. Now, the Irish tax authorities and other global tax authorities also tend to have an industry focus, right? So where are they looking at? They're looking at your key industries, technology and software, financial services, pharma, consumer business, that type of thing. They're looking at that because they can get industry-specific experience, understand more about that industry, understand what competitors are doing in that industry, and then they can target a number of different players within that industry. This is a very common approach. It's not, they never declare it from the rooftops if that's the approach, but we see it in practice that there will be somebody who's kind of specific, they will specifically focus on key industries and take the learnings from one audit and bring those learnings into other audits where they can be, better served from a tax authority perspective to understand what the risks might be. So lots of kind of key focus areas in terms of controversy. And the big item here is that no documentation, no defence. The onus is on the taxpayer to support the arm's length nature of their transaction. And this documentation is your first narrative to the tax authority to support what you're doing and how you do it. So getting that right is really, really critical. Very quickly in terms of the Ireland TP controversy life cycle, and then Raj will go into some specific details on APAs and maps. But what normally happens is you'll get a request for information, and this can seem very innocuous or very innocent. They'll ask you for, oh, please give us your local file and give us this and give us that, and they'll be asking some random questions. Sometimes they will send these out in a spate. So we've seen the same letter maybe go out to 10 different clients, right? The same thing, just provide us all of this. It will be certain data that they will be asking. It might be a bit of a scattergun approach, but once they've requested that information, you can be sure that they'll be scrutinizing every piece of information. After that, there's typically some interviews with business and the tax authority to understand what they do. And then there's a kind of a formal process, a letter of findings, a defense, giving evidence to prove that. There'll be some sort of an assessment issued. And, you either negotiate and settle it, you come to the conclusion that there is no adjustment, or you litigate, or we go through one of the kind of alternative processes. But I just wanted to talk a little bit about avoiding the assessment, right? Defend or negotiate. So trying to set yourself up in a position that you don't have to get into these complicated mechanisms, which are obviously very time consuming. Again, it sounds like old hat, but the importance of your transfer pricing document, right? Making sure that, first of all, your model isn't out of date, that we aren't just doing the same thing that we did 10 years ago when we could do something different, but that we have updated and invested in our transfer pricing model, the economic analysis and benchmarking to support that. If it's a complex model, there is often a lot of value in doing corroborative analysis. The light touch approach to transfer pricing, frankly, is a little bit out the window, right? In every court case, the economic analysis and benchmarking and the functional analysis is absolutely ripped to shreds, right? So that support is really critical to have a base and a framework to avoid disputes. If we don't have this, we're already starting at, the wrong end of the stick. There's also evidence. You need to have evidence in forms of your legal agreement, your documentation, cost-based data support, evidence that support what you do. Again, your document is not something that's on the shelf. You have to have the evidence to implement it. And it will always, be requested if you do get to the dispute. But this is definitely your first step to kind of getting to a successful conclusion, to being able to answer a tax authority's question and hopefully close off the matter. What information does the tax authority look at in a TP audit? Obviously, your TP documentation. Then they have all the data that's filed with the revenue, financial statements, your tax returns, payroll data, country by country, information in the public domain. They scrutinize it. What does your website say this? What does this say? What does your company's office say? So all this external information that's available to them. And then any information that's exchanged through different methodologies. So there's a lot of information that the tax authority has. And then they will scrutinize this. And what's very commonly done is they're mapping. Does what your documentation say map to all this other information, map to the interviews that we have with your business, and does it tie up? They're looking for gaps, they're looking for holes that will lead them to some sort of a conclusion. The audit information requests are extremely wide-ranging. They're not just asking you this information that you might have tidily tucked away in your desktop drawer. They could be asking a lot of information about counterparties, other entities' cost base, other entities, stuff that you mightn't have easily to have. And a lot of different evidence, like we're always looking historically in transfer pricing, typically, right? So they want evidence that something happened 4 years ago and Mary is no longer in the office. So how do we prove that? So creating this framework of understanding what a tax authority might ask and what evidence actually the taxpayer has the obligation to provide to defend its position is really, really important. So anyway, we need to kind of manage this process quite carefully. Think about what information we provide. Think about what information we don't provide, because every piece of information serves a purpose, either a good or a bad purpose, and will be scrutinized, right? So we can't just casually dole out information. We also have interviews with tax authorities. What's important there is, they'll be interviewing your local staff. Do they actually understand the transfer pricing model? Often the transfer pricing model is really separated from business and it's some sort of a tax or finance function that nobody really cares about. And then they're going to interview them, they're going to say, what do you do? What is your role? Big mishaps often occur in these casual interviews that the tax authorities have with businesses, because businesses aren't fully aware what is transfer pricing, what the model is. So it is really important, if you want to have a sustainable TP model and to avoid situations like this, is that key people in business understand your model. And that will help hopefully avoid some of the common mishaps that we see. When they say anything you say in these interviews will be used against you, and that is very common, right? Whatever you say in there, which can be just casual things like, no, the UK tells me everything I'm supposed to do, or I tell the UK everything they're supposed to do. These kind of common mistakes can be used to haunt you. So we need to be careful and we need to ensure we have the engagement of our people. Now I'm going to hand it over to Rajneesh. So let's assume we haven't been able to wave goodbye to the taxpayer. We have some sort of dispute resolution mechanisms, MAPS being the first one. Raj, over to you to talk us through this, please.
Thank you, Gabrini. So there are two significant dispute resolution mechanisms available to taxpayers. One of them is an APA. The second is a MAP, or Mutual Agreement Procedure. So Part 350207 and Part 350208 deals with APA and MAP in Irish TP legislation and the Tax and Duty Manual. Briefly, what is a MAP? So MAP is something, a taxpayer can apply in current situation where the taxation is not in accordance with the double tax agreement or as per the EU Arbitration Convention. However, APA can be applied for tax certainty in the future for a prolonged period of time, say approximately 3 to 5 years at least. So let's first deal with what is MAP. MAP is a means through which competent authorities consult to resolve dispute regarding the application of double taxation convention. The MAP article in Double Taxation Convention allows competent authority to interact with intent to resolve international tax disputes. Now, these disputes involve a case of double taxation where same profit have been taxed in two jurisdictions. So what's the ultimate objective of MAP process? It's to negotiate an arm's length position that is acceptable to both tax authorities and to seek to avoid double taxation for taxpayer or avoid taxations not in accordance with double taxation agreements. Now, before entering into any kind of resolution mechanism, taxpayers always need to evaluate the pros and the cons. The pros, obviously, in the greens, it's elimination of double taxations, ensuring that the same income is not taxed in multiple jurisdictions. The dispute resolution mechanism for resolving cross-border transfer present disputes outside of formal litigation. It definitely improves tax certainty, offering business clarity for their tax position by reaching an agreement between tax authorities, and then it maintains relationship with tax authorities. It encourages cooperation between tax administration, reduce the risk of aggressive audits or prolonged disputes. But obviously the taxpayer need to first look at the cons, all in the red. It's a time-consuming process. MAP resolutions could really take several years, leading to prolonged uncertainty. There's no guaranteed outcome. The tax authorities are not obligated to reach an agreement. Say Irish Revenue may be agreeing to it, but the other jurisdiction may not be agreeing, which may leave the issues unresolved. Its limited scope, MAP typically focus on double taxation relief rather than broader TP disputes or penalties. And definitely it is very resource incentive. It requires significant documentation, engagement with authorities consistently, and legal and tax advisory cost. Now, how do we make a MAP request? A taxpayer must submit a formal written request to the competent authority with all required information. It's all outlined in Section 2.1.2 or Part 35.0.8 in the Tax and Duty Manual, as I mentioned earlier. The request must pertain to an action, as I said earlier, has not resulted or is expected to result in taxation not in accordance with the double taxation agreement or the EU arbitration convention. Now, under the EU TDRM, or what we call as tax dispute resolution mechanism, a taxpayer may submit a complaint equivalent to a MAP request to the competent authorities of each member state involved in the dispute. Now, if there is an ongoing MAP proceeding under a DTA or EU arbitration convention concerning the same dispute, that will be automatically terminated the moment a taxpayer initiates a complaint under EU TDRM. So any existing MAP would automatically get terminated once we file a dispute under EU TDRM. To be valid, MAP requests must be submitted within a statutory time frame. This is generally 3 years, but it depends. Some treaties may provide a different time period. So there are two stages of MAP process. The first stage is where a taxpayer can request a competent authority, especially Irish Revenue, whether they're eligible to apply for it or whether it appears justified and well-founded by the taxpayer, the request. And once that is agreed, the complaint, either the Irish Revenue can solve on a solitary basis, or if required, under the EU TDRM process, the Irish competent authority can contact the relevant competent authority of the other tax jurisdiction. That involves second stage. In the second stage of MAP process, the Irish competent authorities engages with the competent authority of other jurisdiction to resolve the disputes by mutual agreement. However, as mentioned, there's no guarantee of resolution. Other jurisdiction may or may not see eye to eye on the negotiations. And sometimes that may not be acceptable to taxpayers. So if the competent authorities fails to reach an agreement or if the taxpayer rejects the MAP outcome, the taxpayer may still pursue any available domestic legal remedies. So what is the resolution of MAP request? There are a number of potential outcomes in a MAP case. Unilateral relief, as discussed earlier, competent authority agreement for full or partial elimination of double taxations, no competent authority agreement is reached, MAP request withdrawn by the taxpayers. These are the four outcomes which is possible. Annual report 2020, it was released in 2024. What is the status of MAP cases in Ireland? And it's a staggering figure to be noted. Ireland's inventory to TP MAP cases increased substantially from 77 to 90 in 2023. 30 new MAPs initiated and 16 MAP closed. The double tax relief was eliminated in full in 88% of the cases in 2023 and 14 of 16 closed cases. Of the remaining closed cases, one taxpayer was denied MAP access and another withdrew the MAP application, as the four outcomes are there. The average time to close a TP MAP involving Ireland was very, very welcome. It was better than the OECD average of 32.01 months. It actually was 31.50 months only in 2023. Based on closing inventory at the 2023, Ireland most significant MAP partners are Italy, Spain, US, and the UK. So that clearly shows that, there are 7 new transfer pricing MAP cases and we are having increased level of Irish UK tax disputes. Next slide, please. So the next the dispute resolution mechanism is APA. APA is actually a binding contract. It's futuristics. The taxpayer requires tax certainty. So they might contact with the tax authorities and try to agree on a significant transfer pricing policy, TP method, and and get a tax certainty over a required period of time. These agreements are designed to proactively and cooperatively resolve actual or potential disputes. It serves as an alternative to traditional audit and examination process. And what are the strategic advantages to companies? It definitely, as I said earlier, provides tax certainty regarding accepted TP methodology and reducing the risk of disputes. It simplifies the financial reporting of potential tax liabilities. Additional APA helps mitigate the risk of double taxations. It lowers compliance costs associated with audit defense and documentation prepares, and enhance transparency in dealing with tax authorities. So again, as I say, taxpayers need to definitely evaluate the pros and cons of each dispute resolution mechanism. The pros all in green. APA provide tax certainty. APA minimize the rigors of audit and delivers a particular tax income based on terms of the agreement. APA reduces the risk of TP adjustment. It reduces the risk of double taxation for futuristic cases. Tax administration taxpayer can consult and cooperate in a non-adversarial environment. The cons are all in red. It requires full disclosure of information, and taxpayers need to be very careful about it, that if disclosure of information may lead to more problems for the taxpayer. It may take 2 to 5 years from the application to approve. So it generally takes around 2 to 5 years approximately, something hovering around 3 to 3.5 years on average. APA may become void or need to renegotiate if the terms of the trade or the terms of the transaction changes once APA is negotiated, or unexpected economic events like recent COVID-19 make an APA void. Next slide, please. So what are the factors likely? So both MAP and APA, taxpayers can apply, but whether it's likely to be accepted or not, the tax authority will evaluate and decide. So what are the factors likely to result in an APA request being accepted by Irish tax authority? If there is significant doubt of TP methodology to be used in applying arm's length principle, there is a likelihood of double taxation arising if there is no APA in place for certain transactions, or for subject to map certain transactions they've already mapped, and there's a chance that could result in a double taxation. Taxpayer is applying a bespoke TP methodology, not the common 5 TP methods, or application of TP method is complex. It involves complex calculations like profit split methods. Certain times we don't even get reliable comparables when we perform benchmark, or it requires complex adjustments. Those kind of cases can be considered too. The transactions which are to be covered by an APA have already been entered into or are about to be entered into are not hypothetical and are not expected to change throughout the APA period. So these are the factors which are key for Irish Revenue to accept an application for an APA. Now that brings to the question, what are the cases where an Irish Revenue will not accept an APA? So routine transactions, any routine transactions with no complications are unlikely to be accepted. The transactions to be covered by APA request a small portion of Irish entity overall cross-border transactions. So there is no motivation for Irish Revenue to accept such kind of cases. The transactions which are subject to of the APA appears to be a part of a scheme aimed at avoiding tax. Anything which seems to be a scheme to avoiding tax will not be accepted by tax authorities. The taxpayer is involved in a case with Tax Appeals Commission or in court proceedings or in respect of matter related to the transaction, that will not be part of an APA. Or where the APA is requested, rejected by relevant double tax treaty partner. So there are 3 kinds of APA: unilateral APA, bilateral APA, multilateral APA. Irish Revenue does not offer unilateral APA. It only gets into bilateral APA. You can have multilateral jurisdiction, but Ireland will go into a series of bilateral APAs to cover the multilateral APA consideration. So what is the APA process in Ireland? The APA process is made of the following stages, as you can see in the screen. It's a pre-filing stage where taxpayer engages with revenue TP's branch to discuss whether they're eligible for a potential APA application. Once the eligibility is approved, the taxpayer needs to do a formal APA application. Once they submit the formal application covering the first accounting period, they need to submit identical APA application to the other tax jurisdiction as well. The third stage is the evaluation of the API application and negotiations on API. Now, this stage involves, the taxpayer needs to involve within 16 days any information request. So 60 days is mandatory. Revenue may conduct site visits, interviews, or join meetings as required. Fourth stage is a formal agreement. Revenue will notify the taxpayers of agreed API terms requiring acceptance within 30 days. Once taxpayer accepts their formal agreement within 30 days and commits taxpayer to APA, then the APA is signed. If the taxpayer do not accept the agreement, they can withdraw from the APA agreement. The fifth stage is the annual reporting. The taxpayer must submit an annual APA report to revenue by corporate tax return deadline once you have signed an APA. So every year there's an obligation to report for the APA.
Raj, maybe just before you go into the Irish TP controversies, I think what's obviously the key aim here is to avoid getting into a dispute or having a robust policy and documentation. And then mapping APAs, they're obviously for quite specific circumstances, generally for complex and high value issues. It is suitable, certainly in some key cases, and can provide a lot of advantages. But it's only suitable in certain cases. If we're dealing with something routine, more simple, we just need to document and get it right. But let's talk about these Irish TP cases. I mean, it's quite interesting what's happening here. And what we're seeing is legal precedents being set. So lots of learnings. Talk us through these cases, Raj.
Yeah, Kripini, thank you. So as you rightly said, Kripini, there are a lot of interesting cases coming up. So taxpayers need to be aware in Ireland that we were always least worried about transfer pricing, that there will hardly be any court cases. It's a wake-up call. Irish Revenue has heard the first transfer pricing court case in 2024. If we can move to the next slide, please. So in 2024, this court case actually deals with an Irish subsidiary of a US parent. This is a software development company. The Irish subsidiary provides sales, marketing, and contract R&D, software R&D services to the US parent. The Irish subsidiary charges a cost plus 10 to the US parent using the transfer pricing TNMM method. So the method is not, transfer pricing method is not in dispute. The markup is not in dispute. Interestingly, from 2015 to 2018, Irish entities' employees were granted stock-based awards, or commonly known as stock-based compensation from the US parent. So Irish subsidiaries were not charged for that. The cost was actually US parents. They were paying for the stock-based awards. Now, Irish subsidiaries' income statement showed a cost of stock-based award, even though it was not charged for them by the US parent company, because it was required by the Irish Financial Reporting Standard 102. Now, there was no markup applied on this cost because Irish subsidiary did not incur a cost for stock-based award. However, because of the local financial reporting standards, Irish subsidiary needed to account that as an accounting treatment. Irish Revenue Commissioner, as earlier Cabrini mentioned, that any company making loss will always be looked upon by the tax authorities. Now, this subsidiary was making a loss. An Irish Revenue Commissioner raised assessment saying that Irish subsidiary will always be making loss because they're showing the stock-based award as a cost, but they were not actually charging a markup. So the cost provided for the services is not reflective of the actual cost incurred for the services. Irish Revenue said the cost for the stock-based award should be included for charging a markup. Now, this cost, obviously, went to the Tax Appeal Commission, and the Tax Appeal Commission had a key question. Can Irish accounting treatment dictate whether stock-based compensation economically borne by a US parent and paid to an Irish subsidiary's employee justifies an AP adjustment? And next slide, please. So this was primarily a cost of economic cost versus accounting expense or accounting treatment. The TAC had key questions. Correct accounting treatment was applied under FRS 102. The accounting treatment did not deal with the key questions from a transfer pricing perspective. Who bears the legal and economic risk related to the payment of stock-based award? And who should be entitled to earn the profit referable to this cost? As per the OECD guidelines, the cost was actually incurred by the US parent and not the subsidiary. So the commission looked into this, whether the issuance of SBA or the stock-based award by US parent for Irish-based employees created an economic cost to the Irish subsidiary. The commissioner relied on OECD guidelines and mentioned that one must look at the function analysis and not the financial statement of Irish company to determine if an economic cost arose. The commission concluded that based on evidence and a robust functional analysis, which we always keep requesting our taxpayers to maintain and prepare of the respective parties, the US parent had not only borne the risk of providing stock-based award, but had deployed the relevant assets and also performed all of the necessary function to administer the plan of stock-based award. Since the whole function, asset, and risk was performed by the US-based parent, the Commission favored the OECD functional analysis approach over deferring to the accounting treatment, as the accounting treatment is blind to the question who bears the legal and economic risk, which ideally is the US parent. So the commissioner ruled in the favor of the taxpayer and said that SBA should be considered as a notional cost in the accounts of the appellant and that the arm's length principle was required that they are excluded from the cost base for providing the services. So next slide, please. So what are the key takeaways? The key takeaway is economic cost takes precedence. Stock-based award did not constitute an actual economic cost for the taxpayer in Ireland. US parent company bore all the associated financial risk and obligations. The importance of functional analysis came into the picture. A robust functional analysis, the intercompany pricing should be driven by the robust functional analysis, focusing on who assumes risk, who deserves benefit, rather than solely relying on accounting treatment. The economic cost, accounting expenses does not automatically translate into an economic cost, and TP is based on economic reality, not just accounting entries. And last but not the least, the most important, substance over form. Prioritize substance over form, ensure that pricing mechanisms actually reflect risk allocation and value creation with multinational enterprises, and have documentations to substantiate that. So that's the first case, Cabrini. The second case is Apple. Everybody in Ireland knows about Apple. Everybody knows that in Ireland, you can keep a lot of profit without worrying much about substance, without much worrying about a TP risk out of it. But Apple court case was an eye-awakening event. So we all know what happened. The EU court ruled that Apple must pay Ireland a $13 billion in unpaid tax. But interestingly, Irish government didn't want that money because that would have impacted the tax-friendly business environment we have in Ireland if Apple has to pay such a big amount. But wait a minute. Let us discuss the case background. What exactly is the case? In June 2014, actually, the EU Commission launched a formal investigation into Apple tax arrangement in Ireland as part of a broader crackdown on multinational tax practices within the EU, obviously. The inquiry was driven by concerns that Ireland tax ruling provided Apple with a selective advantage, potentially violating the EU stated rules. Following its investigation, the Commission concluded in August 16 that Apple had underpaid taxes by 13.1 billion between 2003 and 2014. The Commission found that Apple had attributed profits to a head office that existed only on paper and was not taxed anywhere, so effectively reducing its tax burden. Consequently, the Commission ordered Apple to repay the full amount to the Irish government along with 1.2 billion euros in interest. Both Apple and Irish government, as mentioned earlier, contested in the EU Commission decision, bringing the case before the EU General Court. Well, in 2020, the court ruled in favor of Apple, concluding that Commission had failed to prove that Apple had received illegal state aid. The ruling found that Commission had not sufficiently demonstrated the Ireland tax ruling granted Apple a selective economic advantage. But what is the TP issue? The primary TP issue in Apple case resolves around profit allocations and attribution of profit to entities that lack economic substance. The head office had no employees, had no physical presence, and there was no real economic activities going in. and Irish subsidiaries were allocating a substantial portion of their profit to the head office. Now, this structure effectively allowed Apple to avoid taxation on a significant share of its European profit. From a transfer pricing perspective, the case underscores the importance of substance over form, as mentioned earlier as well. Profit should be allocated based on actual value creation, economic function, asset, and risk borne by each entity. The Commission contended that Ireland's tax ruling artificially lowered Apple's taxable base, constituting illegal state aid. However, the legal debate centered on whether this ruling conferred a selective advantage in violating EU law or whether they were simply an application of Ireland's tax framework. Now, what is the verdict? The verdict obviously overturned the General Court's 2020 judgment and upholding the European Commission 2016 decision. The court confirmed that Apple tax arrangement in Ireland constituted illegal state aid, reinforcing the EU stance on fair competition and state aid enforcement. So the ECJ ruled Ireland tax ruling between 1991 and 2014, granting Apple a selective economic advantage, violating EU state rules. ECJ found that the General Court had erred in assessing both legal and factual aspects, concluding that Commission had sufficiently demonstrated the existence of state aid. The profit allocation and intellectual property, the court agreed the Commission argument that Apple tax structure artificially shifted profits from IP licenses to a head office with no economic activity, no substance. So there was a mandatory recovery of 13 billion euros. Ireland is now legally obligated to recover 13 billion euros in unpaid taxes and interest from Apple, ensuring compliance with EU law. And what are the takeaways from this? Function analysis isn't just a buzzword. It is your best defense. A robust function, asset, and risk in relation to the economic activities is a key. Economic substance over business form. Economic substance is definitely the king. IHTP models are out of date and needs to be sense-checked for alignment with OECD BEPS. With that, Cabrini, I hand it over back to you.
Great. Thanks, Raj. Look, it's obviously interesting to see these transfer pricing cases pop up and how it can impact even when we think we don't have a lot of transfer pricing risk sitting in Ireland. Everybody's complying with the same set of global rules. So if you have a problem on one side of the waters, you have a problem on the other side. So it's really important for, to get an understanding of that and to see how that will play out in the Irish context over the coming years as the Irish revenue kind of shapes itself up to start really enforcing the implementation of the compliance laws that are in place. So what's the kind of key takeaways from here? It's boring, but it's compliance, right? We do need to get compliance. We can't continue to kind of a little bit ignore compliance and say, everything we do is fine, it's great. If we're asked, we'll do it. Because what's happening is you have a compliance, you're legally bound to do something. When you're getting audited, then they'll say, where's your transfer pricing documentation? And you need to have it at hand, right? Just the basic doing business. Of course, then the robust documentation and the supporting evidence is critical to be able to provide to a tax authority when you're the unfortunate one who's under scrutiny. So if you've got high value transactions and you've got a lot of cross-border transactions and transfer pricing is playing on your mind, you really need to get your documentation and ensure that we're not just kind of following what a wider group policy is without understanding the implications and the context locally, because compliance is a local obligation, regardless of what global standard might be. It's really important to keep an eye out on key trends. We are every week seeing a new piece of case law, which is setting the precedents that we didn't have 5 years ago. We also had the big case in France recently. We had the Coca-Cola case. We so many different cases, right? They're popping up and they're actually formalizing the legal position around these areas. So understanding the trends and what's happening in global case law is really critical to making sure that we're on top of what we need to from an Irish transfer pricing perspective. We also need to be strategic about TP. TP isn't just compliance, right? It really governs where value is created, how profit falls, and how you're taxed. So there are key discussions with with the board, with Exco, with understanding what can be done to enhance the transfer pricing model. What are the risks in our current model? There's still a lack of understanding that at a senior level, because it's seen as kind of a tax compliance issue. It's not. You just have to look in the papers and see how we talk about conversations such as the erosion of a tax base in a jurisdiction, and think about the kind of consequences and reputational implications of being on the wrong side of transfer pricing. Now, maybe Apple won't be hurt too badly by that case, but 13 billion is going to hurt somebody, right? And audits, at all costs, we really want to take the steps to avoid getting into audits and litigation and disputes, by ensuring that what we're doing is robust, compliant, and that we understand the risks that we're taking or choosing to take as a business. It's not understanding those risks and not understanding the exposures that create big headaches right down the road. But they cost money, they take time. It can use your whole tax team if you're caught up in an audit. Specifically, transfer pricing is more burdensome than, I would say, any other type of audit, because of the level of information you need. It's not just, it can be information from multiple entities. It can be information from not hundreds of years ago, but at least all the years open for audits. So it can be back to 10 years. So getting it wrong can create costly exposures, as well as the time it takes to invest to get it right or to get it resolved, and then already being on the wrong side of the conversation with your tax authority. But yes, I wanted to thank everybody for being here and joining us today. We will be delivering these slides. There's so much to talk about when it comes to transfer pricing, and we're always here to talk. Please feel free to reach out to us with any questions that you have. And yes, thanks everybody for here. Thanks for Raj for joining me. Raj, I'll let you say the final goodbye.
Yes, Cabrini, as I always say, if your transfer pricing planning is well done, compliance become a routine. If you understand your business model adds substance, everything's become routine. So thank you, Cabrini. Thank you, everybody, for listening to us. Have a good day.
Thanks, everyone.